Hey, what's up?
Living the dream.
Living the dream. I love it. Me too. Me too. You guys ready to be talking about some long options? I'm ready. Ready to party.
Yeah, I need a little credit spread break.
What's that?
I need a little credit spread break.
That was a lot today. Man, we gave it a good old effort, but there was nothing stopping
Yeah,
that
it's
bear
the old
train today.
college try.
Yep. Yep. So good news is, I mean, if we would have just held it, we would have lost 5 grand. So that 2000 whatever doesn't look too bad now, right? Should be in puts after today. Will be in puts, just not yet. So the timing is everything. Let's let it build an up channel. It might go down for 3 or 4 days straight, right? That makes a lot of sense. But the big move will happen after this thing rests, and we'll be catching it for sure. All right. Let's get this party started. Real quick, while we're waiting on a few more people to jump in, because it's only been a couple minutes. I like to give them about 3 or 4 minutes to get in. That way, just sometimes Zoom is just dumb. So, um, let's see here. On a daily chart on SPY, we actually did end up closing above the 10 EMA, which is pretty strong, especially because we were so low below it. I'm betting that we're going to start to get some bull moves through here, maybe something like this on an hourly. An up channel is going to start to come in, maybe up into this range here. That would be your left shoulder head and a right shoulder, right? Coming across. Maybe. If it keeps going lower, then there's a chance we could be coming all the way down into like 497 gap fill. That could be pretty weak. Maybe we'll hit the 20 EMA, then bounce down around, and the 10 will act as resistance. So both of those scenarios are very possible. If this goes down, we'll probably get something like that. But an easy way to start to tell is look at an hourly. So the hourly is already getting oversold some. We have not put in any lower high yet. So I'm curious to see if this does make it into this range up here over the next few days and then roll over, or if we just start systematically bouncing back up to fill this gap and going down from there. If we're looking at the futures are down just a little bit. So let's dive into the hourly real quick. We've got channel galore on this thing all over the place. I'll leave that one up for right now. And let's change the visibility off of this to that. There we go. Okay. So let's see if this actually just double bottoms and then goes bullish. It's possible, but we are very, very extended. So I don't think we're going to be going much lower before we find some bulls and start coming in. So that's kind of where we're at. NDQ, pretty steep drop. Again, I still think we're going to kind of get back up into this range. Makes sense. So yeah. All right. Good enough. Time will tell. Today was a massive, massive moving day down. So now we got to let it build some structure. It's going to be the same thing whenever you lose. It's just easier to hedge on monthly. So you're going to have the same $1,500. It's not going to lose much more than a 1,700 normally because they would have to make a pretty big move below your strike. Today just pile drive below our strike and we didn't even get a chance. Like it didn't even give us a chance. So it kind of is what it is. I think it's $2,400 loss. That's $1,000 more than I wanted to lose on this, but we would have lost 5 grand. So it would have closed down below that. That would not have been fun. So, oh well, kind of is what it is. And now you're going to see a little bit more aggressive trades coming out of me. Again, still great trades, but I would say for the past month and a half with us being ahead, I sit back and I'm pretty conservative. With us being down, I'll take great trades, but I'm going to take more of them. So you're going to see a little bit more frequent trading, just really great setups. If I don't have a strong edge, I won't trade. So you'll be able to see what I do when I'm kind of behind a little bit. And 2 credit spreads, we're back ready to rock and roll again. And or a decent, couple decent day trades, whatever we want to do. But most likely I'll be making this back through some credit spreads and watching price action. So be fun. All right, let's start talking about buying long options. I've chatted long enough. A lot more people have jumped in the room. Let's rock and roll. All right. So, overview for buying long options. We have to realize this is talking about purchasing options. That's what I mean by long options, right? Purchasing options. We have to understand that time is not on our side. Okay. We can't treat it like shares. With shares, if you get in right here and it goes up to here and pulls back to here, you're still green. With options, if you get in here and it comes up and pulls down to here, you're at break even. Okay. And that's true if this is on a swing trade or on a, if this was on 1 hour chart, your break even's there, even though you got in here. If this was on a 5 minute, your break even's here, even though you got there. So it's not really worth it after a large move up to just hold back and be like, I'll just see what this thing does. Because even if it makes it back up to here, you've lost this much time in theta, which means it's going to have to go up to here in order for you to make the same amount as you had there. So you can't treat it like shares. It's very different when it comes to that. It needs to be moving and it needs to make large moves, and you'll see how I manage those a little bit differently. Choosing the right strike and the right expiration is key to success. I mean, that is going to what separate you from large wins and small losses to large losses and small wins is simply the right expiration and the right strike. I'll teach you how to do that. Timing is everything, supply and demand. So like we talked about right now, everybody and their grandma's buying puts right now. We can't play with the crowd. We have to wait for everyone that bought these puts. Maybe everyone that bought the puts is going to get paid. That's fine. It's not worth the risk. They have a very high risk and a very small reward getting in at the end of today because they paid a huge premium. And as soon as this bounces up some, that premium is going to shrink right back down and they're going to get crushed, even though it's barely bounced, right? And then their reward is not that much compared to what they're actually risking. So we don't want to play with the crowd. We want to play the supply and demand game to our favor. We want to wait for everybody, even if they get paid for another day, we want to wait for everybody to lose. And then when those puts are nice and cheap and no one's even thinking about puts anymore, we buy the puts and we buy it based on price action, knowing there's a pretty good chance we're heading down. Okay. We are going to be talking about our green, yellow, and red management system for after we get filled on a trade. How do we know if it's working or not? How do we know to be patient? How do we know to cut it, etc.? And then we're also going to be talking about ways to manage risk, absolute zero, and then actually putting in kind of like an alert or a stop, etc. And then finally, how to add to a trade. Cool? Let's dive into right now understanding that time is not on your side. So anything less than 30 days, I am less patient with it. And this is talking a little bit more about swing trades, but if you buy something that expires in less than 30 days, you need to understand that is a very strong theta play, which means that option is going to lose value extremely quickly. And that is true for day trades. That's true for anything below 30 days. It's going to start ramping up. And the closer you get to expiration, the stronger that theta is going to be. Okay. What I want to shoot for is to hold it for around 30% of the total time to expiration. So if I buy an option that expires in 30 days, I want to be out of that trade within 9 days, ideally. Target hit out within 9 days. So I do not even want to get close to holding this. People think that they have 30 days on this trade. That's the wrong way of going about it. You need to think about 30% of that time. Okay. So if you think it's going to take 30 days to get to your target, possibly, which we'll get into in a second, you shouldn't be buying this thing 30 days out or even 40 days out. Because if you hold this thing 30 days out of the 40 days, you're going to get beat up pretty bad, no matter if it wins or loses. Theta is going to eat you up. You're giving up a lot of potential profits. Okay. If you think it's going to be taking 30 days, you need to be buying it about 100 days out and holding it for 30 days, target or not, get the heck out. So
Hey, Tony.
Yeah.
Um, I don't know if somebody's not muted, but it's real distracting, some kind of strange noise.
Okay. I think
I
I
think it's
just,
typing. Somebody's typing.
okay.
Oh, okay. It
Sorry.
sounded like water.
I just muted everybody on there, so hopefully that works, but sorry about that, guys. Is there anything that you need me to repeat? We're good? Okay, cool. Awesome. If it's close to your target and it's made a large move in your direction, consider taking profits. Because you have to take into account how long it's going to take to make an S curve. I talked about this a little bit beforehand when we were just starting. If you get in here and your target is here and this thing makes a huge move up, if it pulls back down, you could go up like $1,000 and then be back to zero because your break even is moving up for every little bit that you're in this trade. And it's going to take experience for you to figure out how fast your break even moves up. One of the easiest ways is to go to your analysis tool. So you see me kind of using my analysis tool a lot throughout the day to figure out where my new break even is. Is it worth holding back for? Because I would much rather just take my profits of 1,000 here, pull back and get back in than to give up my $1,000 win just to have it come back to zero. So I have to use my analysis tool quite a bit to figure out where is it going to come back to. Now, if it goes up and it pulls back and my break even's here, so let's say I got in here, my break even's here, and I think it's going to bounce here, then that's worth holding for. Could it come lower? Sure, but the bouncing spot, let's say that 15-minute 10 EMA is up here, my break even's here, I can probably hold a little bit more. But if you use your analysis tool and this is going to be your break even around where that 10 EMA is, or just around the bouncing spot of where you think it could potentially pull back to, it's worth taking profits, some or all, before this thing pulls back. Even if you hold through this, you've now lost, even if you hold through this, you've now lost a lot of time decay on that move. Sometimes it's worth holding. Again, it's all a matter of where my break even is. And it doesn't mean you have to exit all of it, but usually I'm taking profits. After a strong move in my direction, I'm taking something off. And then let it pull back. And if I want to add back in, I can. But I don't want to be constantly being up 500 back to break even, up 500 back to break even. You just don't want to play that game with options. And that's going to happen a lot. Any questions on these things? I'll give more examples on all of three of these, but anything right now while we're on that slide? Cool. If there is, just shout it out, type it in. I'm happy to go back. Okay, let's talk about choosing the right strike and expiration. This is so crucial. Yeah, these rules apply to leaps as well. These rules will apply to anything options, whether you're buying them a year or 2 years out, or if you're buying them same day. It's going to be the same mentality. It's just a different time frame. So the further you go out, right? Now you're talking about, if you buy these things 2 weeks out, now you're talking about weekly candles, right? You're talking about 1 week, 2 weeks, 3 weeks, 4 weeks in a row up. Now you're taking your profits. Whereas if you were day trading, you're talking about 5-minute candles and anything else in between, right? It's the same concept, just a different time on them. So if you're buying these things that expire in 10 months, you're not really paying attention too much to a 15-minute S curve, right? I don't really care that we have 5 bull candles in a row and a 15. It doesn't really matter if these things are 10 months out. It might matter if it's close to my target and I want to see if it's getting ready to reverse off of it or something, but I'm not judging that off of, I should take profits because we look like we'll have a pullback, right? I'm only really caring about it if it's at the time frame that I pay attention to. It's relatively true with debit spreads. We'll dive into debit spreads a little bit more. Debit spreads kind of take the time factor off of it, but they force you to hold for the entire duration. So they cap how much you're making and they force you to hold because you're not going to make your max profit until it's closer to expiration. But it takes theta off the table pretty much for the most part. Not always, but a good chunk of it. Okay. So it does kind of affect it a little bit, but still you still want to be thinking the same way. So first things first, whenever you're choosing your strike and expiration, you want to first determine where your targets are at on the chart. You've got to figure out where you think this thing's going to get to. Remember with coin, when this thing pulled back down, we're like, all right, 185 area is about my target on coin. How long is it going to take for it to get to here on coin? And there's a few ways to go into that, okay? So that's the next part. Figure out how long it's going to take to get to that target. So you could either look at how long did it take to get there previously, right? So if you're looking at this and going, all right, previously when it made a move that big, percentage-wise, or even back to that same area, it took 20, 30 days. Cool. Odds are it's probably going to take about the same thing again. You could use that, or you could use the 20 delta method. I'll show you what that is. Okay, so let's first talk about using the same distance as before. So this is our entry area down here. This is our target. How long did it take for us to move from here, which is our entry, up to that target previously? Well, you can use that little measuring tool right here to figure that out. And if you go sideways, it'll tell you the day. So previously it took 15 days to get there. So then I want to multiply that by about 2 or 3, give or take. Again, you want to be in this for about 30% of the time. So if this thing took 10 to 15 days, you're probably going to be buying this thing at least 30 days out. So multiplying by 2 or 3 is normally going to get you a pretty good ballpark. That's the first way of doing it. And you can do that bullish or bearish, right? But you're just going to figure out going, all right, how long do I think it could take? How long statistically has it taken before for a stock to make that move? You know, you can make a judgment from there. And you want to be erring on the longer side. If you're like, oh, I could get there in a day. It could get there in a day, but it could also take 15 days. Err on the little bit longer side. You're going to be better off buying more time than less. It's going to cost more. It's going to reduce your overall potential return possibly, but you're actually going to have a return. Because if you're too short on that expected time frame or on the expiration, even though you're right, you could still lose on that trade. Okay. Any questions on using the previous move before, data before, to figure out the estimated move? Okay. If there is anything, you can come back and ask it, and I'm happy to go back. Remember, this is not talking about what strike to buy. This is simply talking about how to determine the expiration. How many moves do I use? You're talking about like which one to choose from? Like, should I use this to here or that to there? Can you expound on that a little bit more, David? Pretty much. You can choose whichever one you want. In fact, it's actually kind of nice to use historical. So you go, okay, this was a 7% move. Let me go find the next 7% move and let me see how long that took. Well, that one took 30 days. So you can average many. I normally just look at one. Like previously, a stock that's, of course, not just going sideways, but something that's actually kind of moving. It did an S curve. How long did that take? And then you can find out from there. I don't look at very many. I just look at one, but you could average them if you want to. To be honest, I don't use this method that often. It's a method to use, and that's why I teach it, but the next one is better. All right. So we're going to talk about the 20 delta method. This is the better method to use. It's a little bit complicated to learn at first. Not really, but a little bit more. But it's more effective, and it'll get you closer into the ballpark without having to guess. Because remember, the options price in expected moves pretty dang good. So first things first, again, you've got to determine your target. Okay. Then you're going to go to the options table, and you're going to find the expiration where that target number. So let's say your target's at $100 is your target, not your entry, your target. We're going to get in at $60. Okay. You think it could get up to 100. We want to find the expiration where that $100 strike is about the 20 delta. So 19 or like 23 is fine. Sometimes it doesn't have a 20 delta, but that's going to be the expiration that you're going to use. It's not the strike, it's the expiration. So you're going to go out, let's say you go out 14 days. And the 100 delta is only like, I mean, sorry, the $100 strike. If you're going long, you'd be looking at the calls. If you're going short, you'd be looking at the puts. The $100 strike is only, let's say it's a 5 delta, which means you need to go out more time. So instead of 14 days, I'm going to go out 30 days. Okay, now that $100 strike is a 15 delta. Okay, we're getting somewhere. Now let me go out, 45 days. Okay, the $100 strike calls is now about 19 delta. Great, that's the one I want. So I want to choose the 45-day expiration. I'll give you some examples here and what that looks like right now. Okay, so right here, 154 is my target. We're talking about a short trade. And 154, I chose this because, well, I just chose something, but this was back into a key level, right? And I'm pretty sure this went bearish on an hour. I can't remember, but this is a daily chart. So 154 is my target. I'm going to go bearish on this thing. And how do I determine what expiration to choose? Well, I could just look and see how long did it take to previously get there. I could do that. Or I could go ahead and look and find where the 154, if it doesn't have 154, you could use like the closest $5 increment one. So you could do the 155, just getting you in the ballpark. I went ahead and I chose 10 days out. I just chose a random one. And sure enough, the 154 strike put, we're on the puts because we're talking bearish, right? The 154 strike put is my 20 delta on the dot. If it was the 18 delta, that's pretty close. Good enough. If it was the 24 delta, that's good. If it's a 30 delta, you're too far out. Let's go back a little bit in time, okay? So that's how I would know to choose this thing 10 days out on my expiration, because I'm trying to figure out where about the 20 delta is, which is going to be sitting right around the expected move. That's right around where we're going to be doubling our money, is around the expected move, and that's our goal, okay? 100% return or more. So you notice that that's just my 1R target. I might have a further target below, but I'm at least using my first target to try to figure out what expiration to get. All right. You can set it up on your second target. That's totally fine. But it needs to at least be at target 1 and go from there. Because ideally, I want this thing to be hitting target in a very short period of time.
Tony, on the previous page, it says at the bottom, then by the 3540 delta. Is that just a typo left over from the first method?
Nope, that's the same. That's it. True, because the strike we're going to buy is going to be the 35 or 40 delta. Because remember, we're not buying the 154 strike. We're just using that to figure out the expiration.
Got it. Okay.
Now we're going to come in here and go, okay, here is my 30. Here's a 38 strike. So I'm probably going to buy the 156 strike puts that expire that 10 days out. Yeah, good question.
So you're starting initially with the strike of, in your case, you said like the $100 because that was your target.
Mm-hmm.
Your initial target is the same as your strike, right? But then you're finding the 20 delta to figure out your expiration. And then you're looking at 35 to 40 to figure out the strike you really want to buy.
Yeah, I'm using my target to help me determine the expiration. I'm trying to make my target be the 20 delta. So I just find the expiration that matches my target with the 20 delta. Whatever that expiration is, then I choose the 35 or 40 delta, which in this case would be like the 156 strike puts.
Cool, thank you.
Yep, no problem. Why is that the 20 delta? Any specific reason? It just kind of works. It just kind of works. And it's not always the case. It depends on volatility. Sometimes your expected move is like the 15 delta, but it's going to be pretty close to around the 20 on both sides. So here's the 22 delta right at the expected move. It's going to be pretty dang close. It's just kind of how the math works, I think. I don't know the exact answer behind that, but we can do some more examples. In fact, I think I have another example. No, I don't.
Tony, is
go
this green line, the 154, is that because you were looking for the price that it passed? Is that why we're looking for that?
This would just be my target. You basically, we're back into the 50 EMA. It's at a support, and I'm kind of planning on, I think on an hourly, this thing was breaking down. So it was just an example, but you're just picking your target based on where you think it could get to. At least, to come back down and through here makes a lot of sense, and then see if it'll roll back over. But that I just chose that because it's the EMA around a support. I think that was probably pretty likely for it to get there.
Okay.
Yeah.
Thank you.
No problem. Does the 20 delta make sense? We can go over more examples. So let's say our target is the 142. What would we do? Well, let's look here on 10 days out. Let's find the 142 strike put. What's that delta? It's the 4 delta. So that 4 delta is telling me I need to go further out in time. The further out in time, the closer that strike's going to come to in the money. So the higher the delta, the further out in time, the higher the delta. The less in time, the less the delta. All right. So if 142 is my target, I need to go out more than 10 days. I probably need to go out like 50 or 60 days to drag that 142 strike to the 20 delta or close to it. Again, it might be the 22 delta, it might be the 18 delta, but it's going to be in that ballpark, and that's close enough. I forgot to leave my broker open, and I don't like opening it because it takes like 5 or 10 minutes just to pull up, and then all the numbers are off anyways. But hopefully this kind of give you a little bit of example. We'll go over more of this. We'll do lots of back trades together. You don't understand what the 35 and 40 delta mean. It's basically just barely out of the money. If you go back and rewatch that options video, I go over delta in pretty good detail. So it's the options, intro to options or something like that. Watch that again. There's a really good explanation on delta, but delta is basically, there's a few reasons behind it. There's a few things behind it, but basically it's for every dollar that the stock moves, your option will move the delta. So if you have a 20 delta, your option is going to move 20 cents for every dollar that the stock moves. But here's the thing. If the stock starts to move down, this 20 delta is now becoming closer to in the money. It's no longer the 20 delta. It's going to turn into like the 40 delta. So now you went from 20 cents. As the stock goes your way, you're now making 40 cents for a dollar, and it keeps going and going and going all the way up to, I think, $1 is the most. Yeah. So once you start getting super in the money, it's going to be a dollar for dollar type thing. It's going to act just like the shares. But, yeah. So that's the idea, is we want to buy just out of the money. So we want to be buying like a 35 delta and try to turn that into like a 70 or an 80 delta. So just that alone, we're gaining value. Remember, anything past a 50 delta is at the money and in the money, right? I guess I should say past 50 delta is in the money. Okay. So that's the idea that we're trying to leverage these options with. And that's how they can have this parabolic curve and make a ton of money. How you can get 100% return on it, because we're leveraging all these things. And that's just one aspect into it. There's more aspects that go into the price of this option, but that's just one of them. Okay.
Tony, I think in that option video, you said that one of the aspects of delta is you can think about it as probabilities.
Mm-hmm.
And so, I mean, if we're looking at a 35, 40% probability of the thing being in the money or being profitable, I guess then we're trying to skew that probability with our price action reading. And
yeah, you can increase that by putting the odds that it's going to move in that favor. But yeah, you're exactly right. You could look at it as probability that it should be worth something by expiration. I don't know how much, but something, right? That's kind of, think about it, the probability that it'd be at the money or in the money by expiration. So that's one of the reasons why we don't want to be buying super far out of the money, because by the time, if this thing does move its expected move to 154 and we buy the 154 strike put, yes, it went all the way to 154, but theta's killed us. Is it actually worth anything? Well, if it gets there quickly, it is. But if there's not that much time left, it's getting beat up.
So we're really getting the trade-off between the cost of it and probability and theta, and trying to find a sweet spot.
Exactly. That's why I really like that, like 35 delta. It's kind of that sweet spot where it's actually really close to the money. It's like one strike out of the money, basically, one or two. But it's still leveraging enough that we can get some parabolic moves when it comes to like those coin options, right? Up 200% or whatever. So we bought them out of the money. but they weren't way out of the money. If we would have bought them way out of the money, it would have to have a move like it did there. Like that would have paid out huge, but how often does a stock actually go up 50% in 2 weeks? Once every 7 years. Like it's just not very often. So every trade you take for a month is just going to lose. It's not very probable. Could it happen? Like today on SPY, if you bought out of the money puts, you had been paid huge, but you would have lost for the past 35 trades until you hit that one big one. So could it be profitable? Sure. Especially if you can lose small, but that's always the key. Can you lose small and win big? And that's always what's going to keep you in the game.
Awesome. Thanks.
My pleasure. Any questions so far on the 20 delta method? Remember, this is just to find the expiration. We're not buying the 20 delta. We're just using the 20 delta at our target to determine expiration.
Yeah, Tony, I'm sorry, I got lost somewhere.
It's
Can
okay,
you
Sue.
just go over it like one more time? You were at the 142 and you found the 20 delta.
Yep. So first step is determine your target. So in this case, it's a 154. Okay,
Yeah.
the $154 is our target. Why? I just thought as an EMA, good enough, right? Whatever your target is, even if you chose like 132 could be your target, whatever you want. It could be the gap fill. Your target, you got to choose, right? So you choose your target based on your setup, based on your risk reward, et cetera, where you think it can go to. And once you have your target chosen, now we're left with the dilemma of what expiration do I buy and what strike do I buy? First things first, we got to determine expiration. So we go to our broker, we take this 154 number because that's what our target is. If we're shorting the stock, we're going to be looking for puts. If we're going long the stock, we're going to be looking for calls. So in this case, we're shorting it. So we're going to scroll through all the different expirations. I should have my broker up, man. I'm sorry. We're going to scroll through all the different expirations until we find our target, which is 154. We're going to be on the put side of things because we're shorting it until that is the 20 delta.
Okay.
Once that's the 20 delta, we found our expiration. We're not buying the 154. We're just using that to determine our expiration. Once we have that, now we can start to determine what our strike is going to be.
Oh,
And that's
okay.
easy. You're
That's
just going
where
to
I
buy
got
the
lost.
35 delta.
Yes. Okay. I missed a step in there, so
Okay.
thank you.
No problem. That's what we're doing these. All right. So you get a chance to ask as many questions as you want. So feel free to ask. So yeah, you can buy you're going to be buying the 35 delta. So you find the expiration and then that would be the 156 strike puts basically.
Perfect.
Job. I think we have time to go through one more thing here on timing. So when it comes to supply and demand, we just cannot play with the crowd. Your gut, your natural instinct is going to be like, I want to buy puts right now on SPY. But we want to be buying when all the crowd is selling, and we want to be selling when all the crowd is buying. That's how you're going to make the most money and reduce your risk the most with options. Remember that Google trade that we were wrong on? We were wrong pretty quick on. How much did we lose on that? Pennies, right? We didn't lose very much at all. Why? Because we were buying calls extremely cheap. If Google had bounced a huge amount and then we bought calls, we're buying calls with the crowd, which means if this starts to drop, what is the crowd doing? They're exiting all of their calls all at the same time, and that drives the price super low. Okay. So we don't want to be playing that game. We want to be buying when they're selling, and we want to be selling and getting out when they are buying. I'll dive into more details on that. These option prices get deflated and inflated by the amount of people dumping their options for a loss or FOMO buying in. This isn't a huge portion of it. You're not going to get rich solely off of this. But it does, depending on the option and depending on the FOMO and the strength and what's actually going on, there's quite a bit of, oops, sorry. Cool. There's quite a bit of leverage that you can use, and 10 or 20 cents in the option world that's quite a lot, right? That might be a difference between you buying one extra contract. So the key is do not chase it. Plan your entry when everyone that chased is losing. Let the S curve play out. Okay. With options, it's usually always better to play the retest than it is the breakouts. For that reason exactly. Breakouts, it means it's moving bullish and then you're buying calls, and that's usually when everyone else is buying calls too. It's better to just let it close strong and then retest. And you'll see that on the option prices. So let's say this is a candle, a bear candle, and then we get a nice big breakout, and you're looking at the option prices here, and they're like, whoa, those options, I want to buy those calls, and let's say they cost $1. I want them really, really bad. And then it breaks out, and now they'd be worth $1.70 and $1.80, and you're like, oh, I missed it. And then it pulls back, and you'll notice that at the exact same location, those same options are probably more like 70 to 80 cents. It might still be $1 depending on volatility, depending on a few factors, and depending on how long it took to do that. But you'll notice quite a difference in price at the exact same level. Everyone that bought the breakout, when it comes back down, why? They're losing because their break even is moving higher. It's going to come back down, and it's going to be worth 70 cents down here, and they're going to be losing simply from theta, which means we'll be buying when everyone else is losing. Okay. The last little tip here is the 4-candle rule. Whenever you get 4 candles of the same color moving up, so 4 bull candles in a row, you've got to either get out or take some. Why? Because a pullback is coming. And remember what we talked about. You might be up $1,000 and then be back to break even in just 1 or 2 candles. It doesn't take much. So you're better off to get out of half. You're better off to get out of 10%. You're better off to just get out of all of it and then wait for a pullback to get back in than you are to just give up all the green. Okay, same thing on the bear side. 4 bear candles in a row. And this is on any time frame. If you're swing trading, it could be 4 bear candles on an hourly. Right? If you're day trading, it could be, I usually will stick to on a 5-minute for this rule, but it could be a 3-minute candle rule as well, just depending on what you're doing. But you get 4 candles of the same color in a row. That's when the FOMO is the highest. That's when everybody is buying puts now. That's going to drive the demand up even higher. And there's a good chance this thing's going to return back up and then drop some more. After 4, you're getting pretty dang close. It's very rare for a stock to put more than 4 or 5 in a row before it retests. So, oh, I had a whole drawing thing. I even put that in there because I knew I'd be talking this until the time. Dang it, I forgot to even check. Any questions on the timing with the crowd?
Well, that makes sense. Thank you.
Yeah, no problem. So with that now, I really want to dive into SPY. Because remember, timing is everything on these options. If you buy puts, right here chasing all of this, everybody was doing what? They were buying puts with you. I mean, they were just, it's going to zero. The pullback's finally going to come. What's happening to everybody's puts? Well, just on this little bounce, they're getting crushed. Why? Because the amount of people buying down here is crazy. It's driving those puts up higher. Lots of FOMO. You'll see it run really, really quick. And then as soon as it hesitates some, the value just tanks. It's kind of crazy how that works. You've got to sell it before the bounce comes in. And that's why I like 4 candles. I don't want to be like, well, let's just see if it bounces or not. Because 1 bull candle comes in, what's happening to the people buying puts? No one wants to buy puts when it's going up. They only want to buy when it goes down. Right? So as soon as a bull candle comes in, the buying, the crazy frenzied buying, FOMO stops. And everyone that paid a huge price is now looking at their P&L and being like, how am I down $200? And then they start to exit. And the price really tanks, even with just a barely of a move against you. Same thing on the bull side. 4 bull candles up, and you get 1 bear candle, you'll see the price completely dive. It's not going to go to 0, but it'll be pretty drastic, and you'll notice it the most if you buy calls up here. You will like, man, it barely moved down, and I'm down 30 cents, 20 cents. It's a big deal whenever you're dealing with options. So, is it the end of the world? No. But even on a move down, your risk reward is a lot, because down here, it's not like your break even stays right here. Your break even very quickly moves to here, because this is where it should have been. This is the price that the stock should have been when you bought puts here, because you paid that much more for the price of it. That's another way of thinking about it. So if the options right here should cost $1.50 and the options right here should cost $1, Whenever it comes down to here, the demand is so high that these options cost $1.50 right there. So if you buy that option for $1.50 right there, and then the demand stops, it's going to go back to its normal retail price, which is $1, which means you're down 50 cents right away and nothing even happened. Your break even is going to be right there because that should have been the price of that option. That's where it should have been. Okay. So then it makes it even harder to make money because if this thing comes down, it's not like you're making money from here to here. You're only making money from your break even to there. So your risk is even higher than you think, and your return is even lower than you think. You don't want to play with the crowd. It can work, but it's a really, really, really hard way to make money, and it's very hard to win big, and it's very easy to lose big. So we beat that horse up, but these are all the tips and tricks when it comes to buying these options that if you can learn these rules, it's going to help you play a different game. So what do we know needs to happen before a big move comes? The markets are going to find a way to rest. Once these RSIs start getting super low across the board, so we go out to like a 30-minute, look at the RSI, super low. We go out to a 15-minute, super low. We go out to a 30-minute or an hour, pretty low, oversold. It's going to be pretty hard. It can go down, but it's going to be pretty hard for it to move lower before it at least gives us something. We saw that on the price action today. If we go to a 5-minute, I'm sorry, get this pen out of the way so it's doing that. Big move down. Could it go lower? Yes, but look how low it is on the RSI. So what's most likely going to happen? Most likely going to have some sort of chop to rest. Once it brings that RSI back from oversold, then it drops again. That's just kind of how the game works. So we're doing where we're at right in here is exactly where we're at on the hourly. So why would the hourly be much different? Why wouldn't we get some ping-ponging sideways or maybe even hopefully an up channel to fill this gap, right? Why wouldn't we get that? Have we broken this 2-hour trend yet? Nope, we haven't. Right at it. Haven't broken that thing yet. So we are still technically bullish on a daily and a 2-hour. Is it showing some signs of weakness? That's what a head and shoulders is, right? Left shoulder head, which means you put it in an S curve. Bulls should have been right here to buy it up off of the key level. When no one does, all the bulls exit, and then it retests back up. The rest of the bulls that didn't exit, they get out, and all the bears start to jump in, and then it rolls over. Good chance we're probably doing that. So if we just wait for this opportunity and then buy our puts, who's buying puts here? The people that know what they're doing. No one's buying puts after a big move up. Everyone that bought puts, they're doing the opposite. They're getting out of this thing. They're exiting their puts and they're driving the demand for the price down. So we can get this for an even deflated price. The same thing that I showed you on the other side. Let's say right here, these puts cost $1. And right here, they would cost 75 cents. Well, if the price gets artificially smashed just by the amount of people just saying, I don't care what the price is, get me out of these puts, it drives the demand down. So because of that, the price of these puts could be 75 cents right here. And then when we buy them, they should be $1. So as soon as it starts to go over, it immediately skips back to where the price is, and we're up 15 or 20 cents. Okay. So wouldn't the higher low? Oh, you're right. You are right. This is actually a higher low right here. So we did break it. I'm sorry. I was kind of looking at this whole thing. So probably like more on a 4-hour. It hasn't broken it yet. Yeah. So it's still bullish on a 4. And that's actually quite the hammer on a 4-hour, isn't it? And we've had quite a few hammers come in. Like on a 1-hour, we had a beautiful hammer and it got taken out, that's pretty dang weak. I thought for certain we were going to start finding some bulls here. That's when we were at our spread. It's just very, very weak. Does that mean that it has to go down though? Well, everything's telling us it probably means we're going to go sideways for a little bit. Could news change that? Could we get news tomorrow and gap down to here? Of course. But again, We don't want to be playing the game of buying options. We're going to need, even if it comes down to here, fine. We'll wait for a retest and we'll grab our puts then. It'll give us a retest. We'll get it. Even though right now it feels like it's leaving without us, we'll get it. But yeah, it's true. On a 1 hour, it did. What about a 2 hour? Not on a 2 hour. So on a 1 hour, it's bearish. On a 2 hour, we're still sitting right here, not changing trend yet. But it's showing some serious signs that the bears are taking over.
And Tony, there's nothing that we could have done to predict this gap down, crazy bear day on SPY, right?
I mean, except for the fact of just how extended we are. I mean, it's way up there. And we did hit the expected move, which I believe is everyone's target. We saw that yesterday. It pumped up and then just died. Every big dog in the world just started selling to everyone buying up there. So this is telling me that a move down is coming soon. Yeah, the sentiment through here is very, very strong to the bear side. If we look at like a 15-minute, the fact that it did that and then dive bombed pretty much to the low of the day from the high, made a new all-time high and then just died. That's a pretty, so there was some signs that some bears could come in, but we were already so oversold coming into this. We should have at least held out for a little. That's all we would have needed. And then it just dive bombed. We couldn't find one bull today. If we would have just had one bounce, we would have gotten out of this for break even. So how often will that happen? Not very often. But that just goes to show you, whenever this thing does start to drop, the bear moves are going to be insane. It's not going to be like a soft, easy. When the bulls leave the house, which they might have already, we'll find out whenever we get back into here. This is going to be the really good buying spot for some puts, in my opinion. I'm going to be very excited to buy some puts up here. But whenever we get up there, we'll see it. Because if we start to go down or get some gap downs or something, it can be, we could get some seriously strong selling. But that might have been the one thing that could have told us just how extended it is, right? The amount of bulls trapped is what's causing a lot of this bear strength. So the puts up there, they are much cheaper. So even if it goes the wrong way, our risk is much less. Yep. So even if we buy puts up here, they're much cheaper and they're going to lose value even shorter, like slower in a way than buying puts when everyone else is here. Because everyone's going to be getting out of their puts when we're buying them. You do not want to buy them when everyone's buying them and then get out of them when everyone else is getting out of them. It hurts even more. First off, you're paying a really inflated price for it. But, and again, it's not a huge amount, but it could be 10 to 20%. And that is a big deal when we're talking about an R, right? If you have $1,000 on the line, that's hundreds of dollars that you're losing out on simply by buying it at the wrong time. Not to mention price action in itself is going to beat you up. So yes, you're paying an inflated price, but there's also a pretty good chance it's going to be doing this, which is going to hurt you pretty bad. How far out do I plan on buying puts? So there's two methods, right? I've got two time frames. I got to look at a weekly chart. What's going to be happening here on a weekly chart? We're going to be pulling all the way down to 465. Going to happen. It's just how long that'll take. So is this the time to start thinking about that big of a move? Maybe. It's possible. Anytime the weekly chart gets overbought, it's close. It's very, very close. So it's going to be fun to see how this weekly chart looks like. Do we make it all the way down to the 10 EMA on a weekly? I think we do this week. So if that's the case, we need to judge our expiration off of that. Well, if we go to a daily chart, though, what do we have? Well, the daily chart, we're already about to break the higher low. So it's not like the daily chart's not sitting like this, where we're just going to be pulling back to here and bouncing. Right? This is already breaking. By the time we get in, it's probably going to have broken the trend most likely. And if not, it's probably going to go sideways, and that's where we can have a very easy stop. So I actually would lean a little bit longer term on this compared to, let's say it looked like this. Would I be looking at so much the 460, the 460 target or so if we look like this? No, short term, I think we're going to pull back to this key level and it's probably going to get bought up. So I'd be looking more to capture this move, shorter term puts. Does that make sense? You guys see the difference behind that? This is a perfect S curve. Yes, it will pull back, but most likely it's going to get bought up off of this key level. And I'm pretty sure that's what it did. It pulled back for a second. And then it kept going. So now it's the same story. If this thing keeps going, we didn't even make a key level there, so it needs to make a higher low first. There's your higher low. So now we're just hanging out and going sideways, right? We've already pulled back to the key level, close to it, and now we've already bounced off of it. So if we start to break this trend, that means we could actually see some big bears come in, a bounce, and it's going to start making down moves, down channel, everything. So the weekly, once the daily goes bearish on its trend, I'm looking longer term on the puts. So I probably would be considering puts that expire. I would have to look it up. I don't know, but it's going to be more than probably 3 months out, realistically, to get this down to 460. And then I believe at 460, we're going to be finding some bulls somewhere around here and probably start working our way back up again based on this S curve. Is it possible that we just come back to this support? Very possible. We could just come down to the 20 EMA and not even make it to 460. We might just go to 480 and then bounce. That's very possible too. We'll find that out though, because if the daily will go bearish at this point, if the daily goes bearish, well, then the daily will go bullish down here. And we'll know, okay, well, we're bouncing off of 480. But for me, I think with how extended this is, I think we will bounce off of 480, but I think we'll have one more dip to come in. So probably a strong move down to 480 area, this support, come back up, and most likely fall back down to our target. And then we should have a nice down channel most likely. And then we can wait for that thing to break to go bullish again. And maybe it doesn't. Maybe it just falls off the face of the earth. That's possible. I doubt it. Highly doubt it. This is an election year. I think we'll pull back pretty far. I mean, it might come all the way down to 430. But I would imagine we're going to be finding some bulls here again off of like the 100 or the 50, just like we did before.
So Tony, there's a big gap, 497 up to 503. And you were talking about buying some puts like on the S curve when it comes back up. You think, how can we play to take advantage of knowing that gap's potentially going to fill?
Yeah. So we could do some shorter term plays here, back up, and then get into our longer term plays there if we want, right? So let it break the higher low and then retest it so we can make money from here to here based off of the hourly chart, because the hourly chart is bearish. But even if not, I mean, oh, I've gone, hold on, I need to, there we go. That looks much different. We've gone bearish. So even just the S curve back up into their EMAs, which would also be this resistance, makes sense for a rotation over. We just play that, or you could play the head and shoulders and just say, this is the right shoulder and be a little bit aggressive and move down. No matter what, my stop would be up above that. So we could kind of do some short-term puts here and some long-term puts here. Come over, let it fill the gap. That'll be our target for the short-term puts. Take profits on that. Come back up and then just leg into even more long-term puts that we already got into and play that game. So you can kind of stagger a couple. We just need to make sure that our risk on both of those is not going to destroy us up here.
Right.
So
that's like, you remember at the beginning of the year, we were talking, there's a couple gaps quite a ways down.
oh yeah,
right?
Tons.
440 to 444 and 428 to 432. So
there's so many gaps.
At what point do we start thinking about, maybe trying to take advantage of those? Do we just, one gap at a time? Because I mean, we don't know how deep it's going to go, right?
Yeah, I'm gonna prepare myself for longer term up here. And if
Okay.
if it doesn't ever make it there, then so be it. But up here is the place to start preparing longer term. And longer term for me would be like a daily a trend change on a daily. So
Okay.
yeah,
We'd be looking for it to be bearish on a daily before we start picking up some longer term puts.
that would be the safest way. I still might grab a couple longer term puts whenever I'm doing my shorter term puts.
Okay.
I'll probably do that just because of the circumstance. I mean, this weekly
Right.
chart is insane. It is absolutely ridiculous. Once the dam gives away on this guy, it's not going to come back very softly. I mean, it's probably just going to fall off a cliff. So,
Right. I was thinking like it's the same strategy buying puts that we just talked about, right? Measuring how long it took to get to where it's at, and
Yep.
then, you know, doubling that, and then trying to come up with an expiration that far in the future, which could be, I don't know, a year, right? Before
Yep.
we just don't know, right?
Yep. And a lot of the times whenever I'm adding to a trade, I'm doing it by taking advantage of the short-term swing. So if we come down and then it bounces and I get in short here, I think the next real move could be about 480. So we could get into long-term trades that we're not going to take profits until 460, but then I could have some short-term puts that I'm going to take profits at 480. I'm going to stay in my long-term ones.
At the same time.
Yep, at the same time, and then let that thing bounce. And then I'm going to jump back in here and go, okay, well, if we made it down to 480 and then it bounces and we come back in here, I'm going to get into some short-term puts and see if we can't get to the next one. And so you can make
Yeah,
some
so
money
as
by
we leg
adding on
in-
short-term.
As we leg in, we're gonna be adding to our position. And I would imagine that the options are gonna be appreciating, so to speak.
Yeah.
Those longer term ones as it S curves down.
Correct. Yep, that's the idea. Is I want to make sure as long as I'm reducing risk, I can keep adding. And we'll get into that when we talk about adding into the trade. So
Yeah, I want to try to make some big money on these, filling these gaps at the bottom.
yeah, there's going to be some money to be made on the way down, and then I think all the way back on the way back up. So especially if SPY leaves this gap open here at all-time high. So yeah, there's some potential there for some decent money. But we're going to take advantage of it. In the meantime, we'll keep doing some short-term spreads. Again, 2 or 3 spreads will make back this loss. And we should be back on the green here by hopefully next week. And then start getting ahead. And then we'll just be waiting on these swing trades, because I think these swing trades on SPY, we've been waiting and waiting and waiting. And if we can get our opportunity and pull the trigger and have the small risk, we could get some life-changing money out there for everybody. So could be very, very fun. All right. Good little session. We've covered a lot, and I will see you bright and early tomorrow morning. Question and answer period is tomorrow, so come ready with your questions. Remember, question and answer period can be about anything. It doesn't have to be about topics that we're talking about this month. It can be on anything. So if you still have questions on the analysis tool, or if you still have questions on whatever, that's the perfect time to ask it. So come prepared with your questions, and I will see you tomorrow morning for pre-market to see what this crazy market's got in store. But I think the bulls are showing some cracking. I think it's very, very close, and I'm going to start legging into some longer-term puts on retests. So, love you guys. Have a good night. See you guys.